Welcome, everyone. Appreciate you joining me for my monthly webinar on the short, beautiful webinar to talk about the new tax bill. It's 12 noon, and so I'm going to get started by sharing my screen. So the topic, again, short, beautiful webinar to talk about this new massive tax bill. And apologize for the waiting room, but I'm going to try and manage that and present at the same time. So we'll get started. A little legal disclaimer. We've made every effort to provide accurate information, and you're welcome to use any of the information. However, we just ask that you let us know beforehand. So this is part of our best practice webinar series, and this one specifically is on tax planning. So a little bit about today's agenda. We're going to cover all this over 30 minutes, which is quite a bit. And hopefully you agree that this is a short, beautiful way to look at this massive new tax bill. There might be a better way, but this is, I think, going to be very beneficial to you. So we're going to talk about tax planning, what it means, our approach to it. We're also going to talk about individual big deals that are in this tax bill, like tax rates, senior deduction, tips and overtime. We're going to talk about some family big deals, which include the new Trump accounts, as well as child tax credits. We're going to look at business big deals, which are bonus depreciation, QBI, and R&D. Small deals that are in this tax bill include SALT, state and local tax deduction, standard deduction, and charitable contributions. So we're going to try and get through all of that in 30 minutes, leaving some time for questions. So tax planning. A colleague of mine talked about a new tax law as the same as buying a new mattress. Looks great at first, but there's fine print and it sags in a year. This is from Ed Lyon, and I think it's appropriate. We'll get into some of the fine print, but I think it's relevant, especially given this bill. And then Supreme Court Justice Oliver Wendell Holmes called taxes the price we pay for civilization. And our goal of tax planning work is that our clients don't pay retail. We identify relevant discounts and then help them execute and take advantage of legitimate discounts that make sense for them. So the first individual big deal that is in this tax bill are the tax rates. So the TCJA tax rates that went into effect for 2017 were set to expire at the end of this year. What that means is if the tax rates were not, if the tax bill did not pass on July 4th, the taxes would have increased accordingly. And so what I've done is estimate based on different income levels for married filing joint filers, what that increase would have been dollar-wise as well as percent. And I think what is really helpful to get some perspective is to look at it based on a percentage basis. So if we look at the lowest income level that I estimated, it is 40,000 for a married filing joint. That increase would have been 41%. Now, if we go to the top of the scale at $1 million, that increase would have been 9%. So, and if you look at all the different income levels, what you'll see is everyone's taxes would have gone up had this tax bill not passed. And so that is definitely an individual big deal, that at all income levels, we're better off by having to pay less tax. Next, this is a big individual big deal, tips and overtime. So no tax on overtime pay and tips for the period of 2025. This should be 2029. Something to keep in mind, it is not on every dollar of tip and OT. Rather, it is 12,500 for single filers and 25,000 for married filing joint filers. And the overtime needs to be paid in accordance with the Fair Labor Standards Act, which typically is over 40 hours and time and a half. And the deduction for tips and overtime phases out starting at 150,000 for married filing, or for modified adjusted gross income of 150,000 for single filers and 300,000 for married filing joint filers. To qualify, the individual must be an employee, not an independent contractor or a gig worker, and the tips and OT need to be separately reported on the W-2. Another individual big deal, the senior deduction. So this is relevant for seniors age 65 and older by the end of the year, and they get to claim an extra $6,000 deduction per qualifying taxpayer. So joint filers potentially would be eligible for $12,000 in extra deduction. It phases out at 75,000 for single filers and 150,000 for married filing joint filers. So what I mean by phasing out, for some of you, maybe that term is new. What I mean by that is you're losing a portion of that and then it caps out. The first family big deal is the new Trump accounts. So this is $1,000 paid by the government for newborns that are born after January 1st, 2025, and born before December 31st, 2028. So what the government does is make a one-time $1,000 contribution into these new accounts, which are tax advantaged and designed to grow similar to an IRA and a 529 plan. Distributions can start when the beneficiary, the child, turns 18 and will be for education, home ownership, and other major life expenses. So the accounts are, it looks like, going to be invested in something like an index that tracks the stock market as a whole. And if you know anything about compounded interest, the significance can be pretty substantial for a child that has 1,000 put in for them, indexed with the S&P 500, and allowed to grow until retirement or even 18 years old. So this is a family big deal. Again, remember, it's only relevant starting January 1st, 2025. The next family big deal is are the child credits. And so the child tax credit was slightly increased to $2,200 per child from $2,000, effective 2025. And the credit is partially refundable. There is no change in the phase out income levels. And then another child tax credit is the one for dependent care tax credits. And families can claim up to $3,000 for one child and $6,000 for 2 or more children. And the eligible expense rate is increased to 50%. And then there's also an adoption credit, which is now refundable of up to $5,000. And the total credit for 2025 for adoptions is now $17,280. Moving on to the business big deals in this tax bill. We start with bonus depreciation. So 100% bonus depreciation on certain improvements to non-residential real property, machinery, equipment, vehicles, with a recovery period of 20 years or less. Now, why this is a big deal is you've just invested in an asset that has a life of, say, up to 20 years. However, you're getting to take an expense for that in the year of purchase. So this can create substantial tax savings for you. Some things to keep in mind is unlike the previous laws, this one is not scheduled to phase down from 100%. And there's some flexibility in that you can elect out of bonus depreciation and apply Section 179 selectively for tax purposes. And, essentially this is to encourage investment. And I think it is a big incentive for businesses that need to upgrade their equipment or upgrade their facility. It's a great tax benefit. Another big business big deal is the QBI, Qualified Business Income Deduction. And this is pretty amazing in that businesses get a 20% deduction for 20% of their taxable income, essentially. So you don't have to spend $1 to get a deduction for $1 in this case, but it's 20%. And so that one was set to expire in 2025. Now that's made permanent, which is really going to save quite a few businesses some significant dollars. The other aspect that changed to benefit businesses is that the phase out was increased. So instead of it phasing out at 494,600, it was increased 50,000. So now the phase out occurs over 150,000 instead of 100. So more businesses are going to be eligible for a QBI deduction than before, which is excellent. The final business big deal that I'm highlighting are the research and development expensing. So under Internal Revenue Code section 174A, business is allowed to expense domestic R&D expenses beginning after December 31st, 2024. And that is the acceleration of the ability to expense research and development costs is helpful for cash flow because they're getting the deduction in the year that they're spending it. They can elect to capitalize research and development, but they are eligible to expense as well. Now, if the R&D expenses are foreign, the business is required to capitalize those over 180 months or 15 years. So now on to some of the small deals, starting with salt. This got a lot of attention. And what this is a deduction for state and local taxes. In my state, Illinois, we're considered a higher tax state, just like California and some others, New York. And so prior to the tax bill, we were capped at $10,000. Now that has been expanded from 10,000 to 40,000 for joint filers beginning with the 2025 tax year and runs through 2029. So this is going to be helpful for individuals that live in higher tax states. Another small deal is the standard deduction. So that is increasing to $31,500 for married filing joint and $15,750 for single filers. And so this is helpful. Less taxpayers will need to itemize their deductions to maximize the benefit of the standard deduction compared to itemized deductions. Moving on to charitable deductions. This changes for individual taxpayers as well as businesses. New for individual taxpayers, there is a 0.5% adjusted gross income floor. So what that means is only the portion over 0.5% of adjusted gross income. So here's an example. If AGI is 100,000, only donations above $500 are deductible. Now, even for taxpayers that don't itemize and take the standard deduction, they can still claim an above the line charitable deduction of up to $1,000 for single filers 2,000 for married filing jointly on cash donations. Made permanent was the 60% of adjusted gross income for cash contributions. So that is a cap on charitable contributions. And on the corporate end, there was the introduction of a 1% floor for corporate charitable deductions. And that means that the corps can only deduct contributions that exceed 1% of taxable income, with excess contributions subject to an existing limitation of 10% in a 5-year carry forward period. So some big changes with charitable deductions, and it affects both individuals and corporations. So there's plenty more to come with this tax bill. It's massive. There are classes that are set up for certified public accountants like ourselves that do this full time, that are over a week. So there's plenty in this bill. But I wanted to introduce you to some of the big changes that are coming down the pipe. But one thing that I hope you walk away with is there is plenty of opportunity in this tax bill. And I think our goal in working with our clients is that they don't pay retail, that we identify discounts that are relevant to them, and then give them the how-to on how to execute and save dollars. So we've got some time for Q&A. I'm going to stop sharing and kind of open up the floor. Feel free to either chat in a question or come off of mute and go ahead and ask. Give everyone a few minutes. Actually, if no one has any questions, why don't you share one of the things that you didn't know prior to this webinar, if you can.
Jimmy, you can always depend on me, to come up with the question. I got Beth McBride with me too.
Oh, nice. Excellent.
Hey, hello, Beth. Anyways, I was surprised about the $6,000 added deduction for seniors, because that affects me. So maybe you could elaborate on that for me.
Me too.
And Beth too, she says.
Yeah, well, that's an extra deduction. You only have to be 65 or older to qualify for it. And for married filing joint filers, it's an extra $12,000 deduction.
Oh, great. Okay, Beth, I guess we can go to Starbucks then.
Oh, wow.
Ed chatted in changes to charitable deductions. Yes, that I agree, Ed. That was surprising to me. The whole idea of the floor of the 0.5% for individuals and 1% for corporations. One thing in talking about those floors is that 0.5% is the one that's relevant for pass-through entities. So most of our clients are S corporations or partnerships in the flow-through. So that flow-through is what's relevant is the 0.5% because those deductions flow through to the individuals based on their ownership. The 1% is relevant for C corps. John, so overtime question, what if we go over 300 married filing joint? Is there any overtime paid deductible, or will it all end up being taxed? So there's that's where the phase out starts. So one thing to keep in mind with overtime and tips is every dollar of income is subject to Social Security and Medicare. This deduction for overtime and tips applies just to that 12,500 for single and 25,000 for married filing joint. And so that phase out, if you're over 300,000, that just means that you're not going to get all of it. All of that $25,000 deduction. Does that clear it up? Excellent, excellent. One thing I was blown away by were the Trump accounts. That was kind of like it'd be a great surprise if I was having a child in 2025, because the government's giving you $1,000 into like an IRA or 529, and for, if you take into account compounded interest, that can actually grow into something pretty spectacular. So that was a nice surprise with that, even though it doesn't apply to me. maybe for my kids and their kids. So any other observations?
Tim, with that, is that being held by the government, and is it possible then to add to it and have tax-free growth, or is it more, is it going to be held like an IRA where you have control over it and you can then manipulate it and invest it as you wish?
That's a great question, Brad. I suspect it's going to be similar to an IRA in that, it'll be held by a broker. There might be, they might be required to kind of comply with the government standards on that account, but I believe they're, and it may be very limited. I really haven't heard anything about the available investments, except that it was going to be indexed with the stock market.
So in other words, Tim, based on the provisions in this law is really subject to the Treasury regulations and the IRS guidance. Is that what we're going to really find out the details on?
Well, and especially on items like the Trump account that are completely new. We haven't seen those before. That'll definitely, require some further guidance on that. But all indications are that it'll be very similar to an IRA and a 529. Well, we're getting close to time. Any last questions or observations, comments, anything you like in the new bill? Hopefully you liked the way that I sliced and diced it to try and highlight some of the key areas. My pleasure, Ed. All right. Well, thank you all for coming. We love saving you all taxes, so if there's anything in here that you want to work on, you know how to find us. Thank you.